Welcome to Pro Mover Accounting. My name is Brock. I'm a managing partner here. If bookkeeping is the solution you're looking for, this will show you exactly what you're going to get every month from that bookkeeping deliverable. The first statement we always want to look at is the dashboard. Anytime we're doing an analysis, this is the first thing we review. What this shows is information for the previous month and information for the trailing 12. The target amounts then are the actual amounts from the previous month and the trailing 12 months. If the revenue was more last month than it was the same month in the previous year, then this variance is going to be green. If your sales declined and now your revenue is less than what it was last year, this variance is going to be red. Same thing for the trailing 12. If for the trailing 12 your revenue was more than what it was for the previous trailing 12, then this variance is going to be green. But if it was actually less than what it was for the trailing 12, then this variance will be red. The way that we perform the accounting, we're always shooting for a 45% gross profit margin. And gross profit margin is purely the money you have left over after you pay all of your direct costs. If your gross profit margin for the previous month is over 45%, then this variance is going to be green. But if your gross profit margin is less than 45%, like it is in this example, this variance will show as red. And the same is true for the trailing 12. If your trailing 12 gross profit margin is more than 45%, then the variance will be green, like it is in this example. Same thing with expenses. We're shooting to have expenses be less than 35% of total sales for any particular period. So if the total expenses for the company are less than 35% for the period, then this variance will be green. And if the expenses for that particular period are more than 35%, then this variance will show as red. The same is true for the trailing 12. If the overhead expenses are more than 35% for that period, then this variance will show as red. If the overhead expenses are less than 35% for that period, then this variance will show as green, as it does in this example. The last metric at the top here is EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's an easy way of saying net operating income. We're always shooting to have an EBITDA of at least 10% of revenue. If the EBITDA is showing as more than 10% for this applicable period of revenue, then this variance will show as green. But if the EBITDA is less than the particular target for this particular period, then the variance will show as red. You'll see that this target EBITDA is just 10% of the revenue for that particular period. On an annual basis, though, we compare it to the previous year, and we can see that in this example, the EBITDA is more than 10% of the trailing 12 months of revenue, and so therefore this variance is green. The next section we're going to talk about is this cash balance. Now we have a formula that allows us to understand what this cash balance needs to be to make sure that you're going to be able to weather the winter season. In a moving company, usually the winter season is when you're bleeding cash flow a little bit. And so we want to make sure that you always have enough cash to sustain that winter period. So we automatically create a target cash balance for you. And it sets certain targets depending on where your existing cash balance is as of the end of the last month. If your actual cash balance is less than the target cash balance, then your only job in your company is to get that cash balance up to the recommended minimum cash balance, in this case, $61,000. If your cash balance is more than this $61,000, then in that case, you really jump into CEO mode. And CEO mode is capital allocation. And there's really four main objectives that we have with our cash once our cash balance is positive. The first thing we do is we always want to make sure that we have the assets that we need, the vehicles that we need, the equipment that we need to make sure that we can operate efficiently. So if you have cash in excess of recommended minimum, the first thing we recommend you doing is buying trucks. The second thing that we recommend you doing, if you already have enough equipment, is paying down any debt that you have. So if you have the equipment that you need and you've paid down the debt that you need and you still have cash in excess of recommended minimum, then you can try new things, try different marketing sources, open up a new location, hire somebody as a business developer to see if they can just increase the revenue that you have. The fourth and final thing that we ever recommend doing is taking dividends. We don't want you to take dividends or owner's draws if your cash balance is not in excess of this recommended minimum. The last piece at the top of this is debt. We never want you to have debt in excess of 15% of the trailing 12 revenue. we've found that if you have debt in excess of 15% of the trailing 12 revenue, the debt payments can really eat into your cash flow. And even if you have positive net profits, you can really start having a degradation of your cash balance. So we never recommend more debt than 15% of your total revenue. And so that target automatically calculates here, showing a variance of positive or negative if there's leverage to be had in the company or if you've exceeded the max leverage. We're going to come back to this section, and it's going to make a lot more sense when we talk about the pro metrics, and you'll see how we can use this to really know how much we need to improve our company. But the next section then is going to be our revenue and net operating profit as it compares to break even. So this orange line right here is our break even number, our average trailing 12 break even revenue. And we can see that anytime our revenue dips beneath that break even line, our earnings are red. And then once we pop back over that break-even line, our earnings are positive. Again, we break through that break-even line, our earnings are red. So it's a great way for us to understand what our break-even is and the impact of that when we break beneath that break-even line to show that we have negative earnings during those periods. Moving on to the next statement, we're going to talk about cash management. Now, this is simply just the change in cash flow for the particular period. And this period is a trailing 12 months of cash flow. Now, just remember, cash flow is not net earnings. You can have positive earnings and negative cash flow because there's things that don't show up on the P&L that play into a degradation of cash flow. For example, buying assets or taking owner's draws. Those don't show up on the P&L. So you can have a positive net earning, but take a lot of money out in dividends, and even though your earnings are positive, your cash flow can be negative. So we always want you to keep an eye on what this cash flow trend does so that you can understand where the money's going out of your moving company. This next section is one of the most important sections that you can look at in this financial statement, and we call it the pro metrics. And here's the idea behind it. We never want you to spend more money than the revenue that you bring in. If you spend more money than the revenue that you bring in, you're losing money. We don't want to do that. But what we do want to do is at least keep 10% of that revenue. And when we keep 10% of that revenue, that means that we have a 10% net operating income. But that only leaves us 90% of that 100 to be able to allocate to different expenses on the P&L. So what we do in the pro metrics is allocate that 90% as targets to different parts of the P&L so that we can understand what is beneath the target and what is better than the target so we know what we need to work on. In this example, we can see that there's a lot of green averages, but some of the red, some places that we have eaten into the targets more than we would like would be sales, payroll, truck lease and rent, or other cost of goods sold, and we'll talk about those in a minute. But if there's any places that we feel that we could improve this company, those are the sections we need to look at. So once we understand what the pro metrics are, now we can go back up to the top and understand what this chart is. And all this is the pro metrics on a trailing 12 that identifies the dollar amounts that we've benefited or exceeded in each applicable line item based on the pro metrics. So in sales payroll, we've identified that maybe we're a little bit over our targets, and we're over our targets by $24,000. If we want to make sure that we hit that target next year, we need to figure out with the same revenue how we can decrease our sales payroll costs by $24,233, and we'll be right on target. The next piece is the profitability or the operating margins. You have two main margin lines that we want to look at, and the first being gross profit, which is this black line. We always want gross profit to be above 45% because we always want to have enough money to pay for our cost of goods sold as well as our overhead expenses and walk away with the 10% margin. And that margin trend then is this green line. This green line is what the company is profiting either for reinvestment or in owner's draws. So we always want this green net operating income margin line to be over 10%. This revenue and net profit chart is very similar to the previous revenue and net profit chart we were looking at. However, it more clearly identifies the net loss whenever we see that revenue breaks through that break-even line. And finally, we have the break-even analysis itself. This shows us that this company on average is paying $35,000 a month in overhead costs. Whether they do $100,000 a month or $300,000 a month, they're paying $35,000 for those overhead costs. But this also shows that with the profit margin they need to have $73,100 in revenue to make sure that they're making money. And again, if we go back to this revenue chart, we can see that anytime they drop in sales of less than $73,100, that's when they're losing in net profits. The final piece of these statements then are the true financial statements. We've reviewed the entire company. We haven't even looked at a P&L yet, but now it's time to look at a P&L. The first P&L we want to show you is a profit and loss comparison. We want you to look at the previous year and the current year so that you can analyze trends and changes between last year and the current year. You'll also see that this shows prior year, prior month change. That triangle means the change between the previous year and the current year. The next chart that we have is the profit and loss for a trailing 12. We don't just want you to look at a P&L for the trailing 12 in one line. We want you to be able to identify trends over the previous 12 months. And so this chart is a P&L for every month going back 12 months. The next statement that we don't have an example of is the balance sheet. Everybody's balance sheet's different. It includes things like assets or loans or cash balance or the equity of the company. You would have one as well, and it's going to be very unique to you. The last statement then that's going to be present in these financial statements is the statement of cash flow. The cash flow chart then is identical to the statement that we saw in the beginning with the cash flow trends. What this does is reconciles net income to the change in cash balance for the period. So if you ever want to know if your bank account's increasing or decreasing, go down to this cash flow chart and look at this net cash increase for the period, and you're going to be able to understand for the trailing 12 or for each individual month how much your cash has changed over that particular period. All of these metrics we feel are important for you to know to better understand and run your moving company. If you ever have any questions, reach out to your accountant. We're more than happy to walk through anything that you need so that you can make sure that you always have that information that you need to make educated decisions in your moving company.